It's your friendly neighborhood Andrew here, and today I have a money question for you. Your friend Paul asks you to flip a coin. If it's heads, he'll give you $200. If it's tails, then you have to give him $100. Is that a good choice? In this video, I'm going to cover exactly why you are going to struggle converting $100 to $200 anytime soon, and why that is baked into your human nature. Today, we're not trying to talk about Bitcoin or anything crazy like that. We're going to talk about money decisions, why you have such a hard time transitioning $100 into $200, and the money mistakes that you make without even knowing about it. Oftentimes, the questions to life are hidden away in books like these, so I'm trying to boil it down for you. Questions like, how do I hack my growth and find financial freedom? And how do I smash the like button for the YouTube algorithm and send my appreciation to Andrew and his channel? If you are new here, please subscribe because I appreciate that a ton, and let's get started. The Paul that I was talking about is Paul Samuelson. He was a giant in economics, and I read about him in this book, Thinking Fast and Slow by Daniel Kahneman. Paul asked his friend about the $100 versus $200 bet, an obviously good bet on average. And this is what his friend said. I won't bet because I would feel the $100 loss more than the $200 gain, but I'll take you on if you promise to let me make 100 such bets. So, what? Hold on. This means that he won't do it once, but he would do it if you promise to let him do 100 times. Now, hold on a second. Shouldn't utility maximizers like Paul Samuelson and his economist friend think rationally? That is to say, a gamble of one should be equally pleasing than a gamble of many. Well, this goes back to prospect theory, and that is at the core of why you are not going to be able to turn $100 into $200. Money almost fell into the trash. In prospect theory, a mixed gamble where a coin flip can make you win or lose causes immense risk aversion. That means that you are a lot more afraid of losing $100 than you are hopeful that you'll win $200. Professor Meatball the dog is offering you a chance to invest in his doggy daycare. He promises that if you put in $100, there is going to be a 50% chance that you come out with $200 or nothing. This comes down to the very basic ideas of investing. If you let a dollar sit and just do nothing with it for 30 years, Graham Stephan in his video said that that would become a tenth of what it's worth now. And this is bad for you. Letting your money just sit and not investing it or putting it somewhere that has a growth potential allows you to fall prey to the idea that money deprecates over time. The thing with Professor Meatball's investment plan is that yes, there was a chance that you would fail and lose your $100 investment, but the equal chance was to double your bet and come out with $200. Let's go back to Paul and dig into a little more economics. I'm sorry it's going to get a little dry, but here is an actual book. Since prospect theory asserts that you are risk averse and you would weigh potential losses twice as heavily as potential gains, that means that we can rewrite the equation that your potential losses are 2x what they actually are. So in your mind, you're losing $200 and gaining $200. Well, in that first bet, then your expected value is 0. So of course you wouldn't take the bet because you're risk averse. However, if we did it twice, if we started increasing the number of times we flipped the coin and made the same bet, then we see an interesting change. The expected value starts to rise. You should expect to see $100 net gain after 2 flips of the coin. Maybe you lose $100, but then you gain $200. That was the wrong way. Maybe you lose $100, but then you gain $200. But even if you weighted your losses twice as heavily as your gains, you would still have a net positive expected value. That's because the chances of you losing twice are equal to the chances of you winning twice. So those two expected values cancel out. But you're still expected to see a mixed bag. Maybe you win one and then you lose one. The expected value from that mixed bag of lose, win, or win-lose is positive. You have a 50% chance of winning 100 out of 2 coin flips. So we can't double that because it's not a loss anymore. Now that 50% chance of winning 100 becomes an expected value of 50 fresh moolahs. 2 independent gambles. Both are coin flips and both award you with $200 if you win and a $100 loss if you lose, both of which would be useless to you if you valued losing money twice as much as gaining money. A net value of 0 that you would turn down both times suddenly becomes enticing. This is how a trader thinks. You win some and you lose some. Even if individually, your risk appetite would reject one of these gambles, together, by not putting all your eggs in one basket and betting on 2 independent gambles, you suddenly have value. It gets even better at 3. Remember, the third toss is independently valueless if taken by itself. The expected value of 3 independent gambles together is $112. That is even more, $62 more in fact, than 2 tosses. It gets even better at 5 tosses, where its expected value is $250 and the chance that he'll lose anything at all is only 18.75%. You see, one choice that would have been rejected at a narrow frame is suddenly very profitable when you take it on a broad frame. This is how traders think. Humans tend to think risk aversely. That's the entire crux of prospect theory. But if you think like this, you will never be able to grow wealthy and start that seed of your finance. In fact, Daniel Kahneman actually wrote a sermon to those of you that are risk averse for single, highly beneficial gambles, such as Paul's friend. Allow me to read it to you in a dramatic interpretation. I sympathize with your aversion to losing any gamble, but it is costing you a lot of money. Please consider this question. Are you on your deathbed? Is this the last offer of a small favorable gamble that you will ever consider? Of course, you are unlikely to be offered exactly this gamble again, but you will have many opportunities to consider attractive gambles with stakes that are very small relative to your wealth. You will do yourself a large financial favor if you are able to see each of these gambles as a part of a bundle of small gambles, and rehearse the mantra that will get you significantly closer to economic rationality. You win a few, you lose a few. The main purpose of the mantra is to control your emotional response when you do lose. If you can trust it to be effective, you should remind yourself of it when deciding whether or not to accept a small risk with positive expected value. Remember these qualifications when using the mantra. 3 caveats. 1. This only works if the gambles are genuinely independent of each other. So this doesn't apply to multiple investments in one industry, which could all go south together. 2. This only works when the possible loss does not cause you to worry about your total wealth. If you would take the loss as significant bad news about your economic future, watch it. And 3, it should not be applied to long shots, where the probability of winning is very small for each bet. If you're given these 3 caveats, you will be in good shape to start thinking like a trader. So how do you avoid this logical trap? Well, let me tell you a little something that will change your perspective altogether and avoid costly financial mistakes in the future. This is a mistake of narrow framing versus broad framing, and you make this mistake every single day. A narrow frame would be if you walk down to the store and you notice that the price of eggs has gone up 30%. Well, that might actually prevent you from buying any eggs today. That's such a huge increase in a small choice. However, a much larger choice like going to college and having to pay thousands of dollars per hour of tuition, you are suddenly going to make that choice a lot more flippantly, even if the price of tuition continues to rise 10%, 20% year after year. You're thinking of the benefits of going to college, such as getting an employment that pays off the college tuition, but you hardly think about the debt. By nature, humans are narrow framers, and they constantly think about the margin of an individual choice. Anything that you can understand, you're going to have more scrutiny, such as whether or not you're going to go and drink a Coke or a Pepsi. But you hardly think about what a much larger decision is going to do for you, such as investing in Bitcoin or Tesla stock today. Humans hardly ever think about the value of your dollar slowly decreasing, and investing $100 today can easily become $200 in a few months or a year. This is the fundamental prospect of compound interest theory. Again, remember to think like a trader. You are a smart person, but you are probably thinking too narrowly. If you have your narrow frame of mind, you will constantly make bad choices that will affect your future wealth. Remember to think broadly and read some books. The big questions in life are often solved by scientists who have already wrote these books into existence. However, so few of us read for pleasure. That's why this episode is brought to you by Audible. I want you to go out and maybe think about this book, Thinking Fast and Slow. I've been working through it for about 20 minutes a day every single morning, thanks to Charlie Chang and other productivity experts. I think that reading a couple minutes a day can really help out. And if you don't have time to sit down and have a quiet space, maybe when you're walking down the street, put on your headphones and listen to an Audible audiobook. You can get 2 free audiobooks by going down below. I also want to throw up a list of my patrons from Patreon. No pressure to join, although it does help me if you go and buy me a coffee. As always, see you guys next time. Peace.